Bruce McCuaig, who is an executive advisor to the federal government for the Canada Infrastructure Bank. He was previously the president and CEO of Metrolinx for 6.5 years, where he oversaw billions of dollars in transit investment in the Greater Toronto and Hamilton area, including the completion of the wonderful Union Pearson Express Air Rail link. And Bruce holds a master's degree in public administration from Queen's University. I've had the pleasure to work with him on the UITP board, and he's done a wonderful job. So, Bruce, it's up to you.
Up to me. Great. Thank you very much for that mercifully short introduction. It's a pleasure to be here again. Thank you, Patrick and Jeff, for inviting me to participate on this panel. I apologize for the fact in advance that I'm going to have to slip away quietly. Hopefully without too much disruption. I just have a flight I have to catch to get me out to the West Coast for later on today. So I'm going to talk a little bit about the Canada Infrastructure Bank and where we are in terms of launching the bank. And I've been actually spending a fair amount of time traveling across the country, talking to municipalities and transit agencies and port authorities and airports and so on and so forth about the opportunity that the bank brings us. And I would say as I've done this journey across the country over the last 5 months or thereabouts, it's highly variable what people know and think and view about the bank, and there's limited information out there, limited understanding, and in some cases some lack of correct information in terms of what the bank is all about. So hopefully I can try to correct some of those misconceptions right now. And I think the first one I'd like to say right off the bat is, first of all, that the bank is an entirely optional opportunity for public agencies to look at partnering with the bank in the future to deliver infrastructure projects. It's unlike the previous P3 screen that was in place for federal funding, where public agencies were obligated to consider a P3 process. This is really something that is an optional extra for you all to consider in the context of your projects. The second misconception I want to say right off the bat is that this does not take money away from traditional transfer payment programs. In fact, as we heard from the minister earlier on this morning, we have funds that are being committed as never before for transfer payments for traditional transit and other forms of infrastructure projects around the country. And when you look at what the bank is, it's an opportunity to use a new tool to try to leverage private money so that we can actually deliver more infrastructure than we would otherwise deliver through our traditional funding sources at federal, provincial, territorial, and municipal levels. So I think those are two really important concepts that and really the objective here is to build more and build faster. So that's what hopefully you'll get out of this presentation as I go through the next few slides. So I first wanted to make sure that I place the bank in the context of the overall program that the minister spoke about. So he talked about $29 billion over the next 12 years for public transit. The total amount of investment is $180 billion across all forms of infrastructure. And all these different colored boxes represent different program focuses that the federal government has. And of course, we all know that there are three key priorities that have been identified: trade and transportation corridors, public transit, and sustainable infrastructure and sustainable energy. So the bank in the lower right-hand corner with the red circle around it is a relatively small proportion of the overall commitment to infrastructure. In fact, the cash expense component of the bank over the next 11 years will be $15 billion. So $15 billion out of $180 billion, you get a sense of the relative weight of the different elements of the programs. And again, the key message I'd like to make sure that you're aware of is that that large amount of money that's in traditional transfer payment money gives all of us, and I think, an opportunity to really expand the footprint of infrastructure in this country and in public transit in particular. The bank's mandate is really, I'd like to talk about really 3 or 4 things associated with the mandate. One, it's obviously to make investments in projects, but those projects have to have a couple characteristics. One characteristic is they have to have a revenue associated with them, because if we're bringing private money to the table, we have to have the basis to provide a return on that private money, as well as a return, hopefully, to the bank, so the bank can continue to reinvest in other infrastructure. So there has to be a revenue generation that the public agency is prepared to, in essence, dedicate to the project over its life cycle. This could be an existing revenue generating tool. It could be something that is not currently used as a revenue generating tool right now. Those are choices that owners will be making in terms of how they want to participate in projects. The second thing I'd like to say is of course the projects, and you might say, well, of course it's this way. Of course the projects have to be in the public interest. And public interest is not defined by the bank. Public interest will be defined by the public agencies, the federal, provincial, territorial, municipal governments. And that's what we elect them for, and their role will be to make sure that the projects that are being funded align with and support the objectives of the various governments that are involved. There's also an assumption and a hypothesis is that there is private sector lenders out there who are prepared to participate in these kinds of projects. And we believe that that's a correct hypothesis, if for no other reason that we know that these kinds of private investors are making these investments in other jurisdictions, whether they're large Canadian institutional investors, pension plans and whatnot, or other private investors. Whether you go to the United Kingdom, or you go to Australia, you go to Europe, you go to other jurisdictions, they're making investments. However, they're not making those investments in Canada, and we believe that if we provide the framework for these kinds of institutional arrangements, then we will attract the capital for these kinds of projects, and by bringing that private capital to the table, we have one less dollar of public capital that we need to invest in that project, and that one less dollar can then be reinvested in other priority projects that you or your public agencies, your governments have in, whether it's the public transit sector or in other sectors. We also know that there are different sizes of investments that different institutional investors are looking for. And if we look at having the large Canadian pension plans, for example, making an investment, then we start to get their interest, we understand, when we have a project size that's approaching about $500 million. However, if we want to attract private money to smaller projects, there are lots of other institutional investors, whether it's insurance companies, Manulife Financial, for example, or other organizations who are making investments in other jurisdictions in the $1 to $2 to $300 million range for projects. So while we don't believe that this particular tool will lend itself to small projects because of the complexity and the cost of transactions, we believe that anything $100 million and up will start to become real candidates for making investments of this nature into different projects. I'm not going to talk a lot about the governance of the organization other than to say that we're in the process of setting it up, and we'll shortly be opening up our storefront in Toronto, and we're assembling the various elements of it. It is an arm's length Crown corporation, so of course it has all the various elements that we all probably know much too much about how Crown corporations function. But this is also a little bit different in that the intention is that the bank will operate more commercially than your typical Crown corporation. It has to operate more commercially because to attract private money, we need to make sure that the due diligence is there to support a commercial decision that makes sense not just to the bank and its board of directors, but to the private counterparties, because there's no point going ahead with these kinds of projects unless we can come up with something that the private counterparties think will be viable. So we do believe that this brings an opportunity to set in place a much more of a business orientation and evidence-based orientation to how we make choices and how the bank itself will be making selections in terms of the projects it will be investing in and the structure of those projects going forward. The government obviously does have a role in setting direction, but those directions we believe will be focused on areas like the overall priorities of federal investments. So I mentioned earlier on about public transit and trade and transportation and sustainable energy. That's the kind of level that we expect the federal government will continue to play a role in terms of setting priorities. And that, of course, If the federal government is one of the public counterparties, then it has a role in terms of identifying the priority associated with the project, but provinces and municipalities will also play a role for projects that are within their area of jurisdiction. We expect that the bank will be putting in place a variety of tools that will vary from project to project in terms of the way in which they will be structured. We think there will be traditional and non-traditional debt instruments. We believe there will be equity instruments. And we think there's also will be an opportunity in some limited cases for loan guarantees. And we would expect that these will differ in the more traditional kinds of P3 arrangements we've done in Canada to date, in that there will be much longer term equity risk at stake from the private counterparties that will have to be paid back over the life cycle of the project. And that as a result, we're trying to transfer more of the usage risk from government to the private counterparty. And I think that's going to distinguish them from an availability payment P3, for example, that we've seen implemented in various places across this country, and we'll continue to see implemented, and of unsolicited proposals from the private sector. And I'm sure everybody in this room are probably a lot like me in that we've been the recipient of these kinds of proposals in the past, and the first thing you do is say, what the heck do we do with them? What's the process? What's the framework? How do we make a choice? How do we ensure transparency? And similar to other countries like Australia and South Africa, the United States in some places, we're going to be setting in place a framework to put in place the evaluation of these kinds of private sector proposals. I mentioned that there's $15 billion over 11 years. There's actually a $35 billion commitment level. About $15 billion of that is on a cash basis. Instrument choice will depend on project. We don't think that we'll be defining ahead of time that here's the template of how these projects will be structured. In essence, we think that these projects will be variable from one to the other, at least in the short term. And one of the things I'm really excited about is actually having a much stronger evidence-based decision-making process so that we know that we're making the optimal selection in terms of project, in terms of technology, in terms of route, in terms of stations, in terms of any other number of factors, because I think the private sector partnership will drive that kind of discipline and need for a focus on the optimal solution. And just in closing, where we are now, we will be launching before the end of the calendar year. We are actually fitting out space in Toronto right now. The chair has been appointed, and Janice Fukakusa formerly was the CAO of the Royal Bank of Canada, so a very experienced individual. I expect the balance of the board will be appointed over the course of the next few weeks, and that the CEO will be appointed shortly thereafter. We would expect that the focus for the first year of operation will be taking from a minimum organization to a more mature organization, and get to the first 1, 2, or 3 projects that the board of directors can review and hopefully make a commitment to be able to deliver on, because we think setting that foundation of project delivery in the end is what will create a sustainable and viable project pipeline over the medium and long term. So with that, I'm going to stop and I'm going to pass this device over to Sharon.